Well, welcome everybody. It's good to see you attending. Um, we are recording this nuts and bolts session so that other people can get a link and watch it themselves without having attended. Of course, the advantage of attending is you get to ask questions whenever you want. I'm going to apologize in advance. I have a bit of a cold, so I'm having trouble speaking, but I will get through this as best I can. So anyway, welcome to step 2. That's step 2 in the 3-step strategy, which I'm assuming that everybody knows, and some people may not, is to develop your plan with counseling-oriented planning partners, commit yourself and your loved ones to a formal and continuous maintenance and education program, and secure appropriate assistance for you and your loved ones to transfer your wisdom along with the rest of your wealth. And so this is step 2, which is the formal maintenance program, and that includes 3 elements. One is the biennial updates for documents, the asset funding reviews, and the training and education. And this, of course, is part of the training and education. Next year, what we're going to be doing is we're going to be having most of our education online like this, so that helpers and family members and friends who are interested in your plan, that you want to have access to this information, can actually log into our website and get a link to the YouTube that will be the recording of this. So this session is about what happens when somebody dies and how we settle a trust. And essentially this is education for the trustees and or beneficiaries, so they can know what happens and how things work. So congratulations, you're a trustee. Now what do you do? First, let's just review what a trust is. A lot of people think of a trust as a kind of a container or an entity, but it's really just an agreement excuse me, between 3 types of people: trust makers, those are the people who create the trust; trustees; and beneficiaries. We end up thinking of a trust as an entity because once a trustee takes over ownership of the assets for the benefit of someone else, they become a taxpayer as trustee, and IRS starts to tax them as if they were a corporation or an individual or whatever. But there are special provisions relating to trustees' taxes, but that's why most people start thinking about a trust as a kind of an entity, when really what it is an agreement between those 3 different types of people. So what is the trustee's job? It's really just 3 things. One is to hold legal title to property. I'm getting a sign here that says, would you like to hide all webcams and stop sharing your webcam if you are doing so? Well, yes, I guess I will. Sorry, folks, for the interruption. So the trustee's job is to hold the property, to vet 1 or more beneficiaries, and to follow the instructions in the trust agreement. Those are the 3 basic requirements that a trustee has to follow. The trustee's duty to the beneficiaries is a fiduciary duty, and it's the highest duty known in the law, a trustee's duty to the beneficiary. So, what exactly is trust settlement? Well, every trust, it's really a trust instrument that gives instructions, as you all know, and the instructions essentially cover various different phases of time. And so what happens between those phases of time, between those different eras in the existence of a trust, are transitions. So during the lifetime of the original trust maker, they might be trustee of their trust, but if something happens to them, if they become disabled, they have appointed a successor trustee, so we have a change of trustees. That's a transition. And so there might be a disability and the death of the trust maker, or the death of a successor beneficiary, because there are also sub-trusts after the beginning of the trust settlement, and also, of course, terminating the trust. All trusts terminate at some time, often way down the road, but they all do terminate. Some trusts, of course, do have perpetual life, and some states allow trusts to have perpetual life, but essentially most trusts do terminate after a longer long period of time. So where are the governing provisions relating to the administration of a trust during a death administration? Well, the first article that really talks about it is Article 6, and that begins by saying that the trust becomes an administrative trust. It names the trust and requires the trustees to get a tax ID number. Then there is personal property. There are personal property instructions that the administrative trustees are supposed to follow. Those are contained in Article 7. And then when the administrative trust is finished, we create marital and family trusts if it's a married trust maker. And then after those trusts terminate, we end up with trusts for the beneficiaries, and those are under Articles 11 and 12. If we have single tax trust makers, the main provisions are in Article 6 for the administrative trust, Article 7 for personal property, and then we create trusts for the beneficiaries in Articles 8 and 9. So here's what it looks like. When we're alive and well, we have a funded living trust. We have a will, and we're going to use it if it's needed, but hopefully we don't. Remember, a will is, we have a pour-over will, and we often call them sort of legal pooper scoopers, because it essentially picks up property that we didn't get into the trust for some reason. So what happens during the lifetime is we transfer assets to the trust, and the trust goes along as a funded living trust. And then that dotted line signifies that someone died, the trust maker died. So after that, we have to create the administrative trust. Again, if there are assets that are not titled in the name of the trustees, then we need the will to transfer those assets over to the trust. So for example, sometimes we decide not to fund motor vehicles. Those end up passing through the will. That gives a person who is designated as executor the ability to transfer the car without too much ado in the trust. It also protects the trust from liability for driving the car after the date of death. And so most of the time the car gets sold in a simplified administration process, and then the net proceeds will go into the administrative trust. So we create the administrative trust, and the job of the administrative trustees is to do a few things. So first, of course, we create the tax identification number for the administrative trust, and we do that fairly quickly. That's done online with IRS, and we can get a confirmation of that. It ends up being sent out to us. And then we establish and fund the administrative trust. And by that, I mean we actually establish a bank account, because we're going to have to collect cash and various different other assets. We'll have income that has to go into the bank account. So we establish a bank account in the name of the administrative trustees. And of course, if the executor is needed to deal with the pour-over will, we coordinate with the executor, as I explained a little bit earlier. And then we have to identify, value, and collect or retitle the assets. So one of the more difficult aspects of estate settlement, whether it's a trust or a settlement under a will, is knowing what the assets are. One of our main advantages of having a funded living trust and being in the maintenance program is that every year, of course, we check the assets, we check where they are, what they are in detail: bank accounts, mortgages, real estate, brokerage accounts, etc., insurance, and beneficiary designations for insurance and retirement accounts. So we know specifically where all of the assets are and how they're supposed to be transferred, how they're owned, and what their value is. And so we don't have to do that morbid scavenger hunt that usually occurs when someone dies. That's one of the main advantages of being in the maintenance program, and that is that we have continually updated information about the assets. But of course, the assets typically are titled in the name of the trustee of the living trust, in other words, the trust maker and perhaps the trust maker's spouse during the trust maker's lifetime. And when the trust maker dies, the provisions in Article 15 of the trust say who takes over. So if we look into Article 15, we will see who the successor trustees are. Well, okay, so if there's a bank account or if there's a brokerage account, that's now titled in the name of somebody who died, and they may have a co-trustee, but the trust itself, which the brokerage account or the broker-dealer, like Fidelity, for example, has to follow, says that the new trustees are supposed to take over. So we have to notify all of the institutions about the change in trusteeship, and that's essentially a retitling process, very much like funding. So like the initial funding and lifetime funding that we do for assets that we have in living trusts. So we retitle assets, bank accounts, brokerage accounts, etc., into the name of the administrative trustees, and then start collecting them and consolidating them, particularly the cash, so that the administrative trustee can actually manage the cash and manage the property. If we have real estate that's owned by the trust, we may or may not decide to retitle the real estate at this particular point. Usually we wait until the end of the trust administration to do that because, of course, we have to file deeds and that kind of thing, or file at the Registry of Deeds. And that's a title issue, and it's a lot easier to do it when we know what subtrust it's going to go in after the administration of the trust. So once we get control over the assets, and we have them in our possession as trustees of the administrative trust, we have to pay the debts, expenses, and taxes. Now notice it says just debts. I don't mean pay just the debts. The debts that are the just ones is the one we're referring to. So one of the administrative trustees' jobs is to make sure that any claims that someone makes to be paid is actually a just debt, that it's actually owed, because we don't want to pay claims that really aren't owed. And sometimes that can get into litigation. Most often it doesn't. So we pay the debts, we pay the expenses, and we pay the income and estate taxes. And we also have the job of accounting for the assets and receipts and disbursements. And then, of course, at the end of the administrative trust, our job is to distribute the balance as provided in the trust. So how do we identify the assets? Well, there are several different sources of information. Of course, the first is the Red Book that everybody has. Inside the Red Book is the location list. Now, I will venture to say that maybe a majority of our clients still haven't filled out the location list, and I would recommend that you do so. It's a really great way to organize your papers, to organize where things are, so that if anybody needs to pick up your Red Book and know where to go for things, they can see in the location list exactly where things are supposed to be. I had someone actually specify their attic stairway as the location of a particular item in one of the location lists once. Also in the Red Book, after the initial funding process, there are usually funding confirmations, but of course over time those funding confirmations kind of get stale. We do keep all of our records here, of course, and we do the titling ourselves with you. So over time, the funding confirmations that are in the Red Book can get a little bit outdated. So the next best place to look is the Step 2 program, and that's us. We have software that keeps track of everybody's assets, and so that we can print reports of what people owe. What people own, what their account numbers are, and all of that kind of thing. Bear in mind that everybody's particular database of their information is separate from everybody else's, so we never get any cross database errors in our funding. But Funding Pro is the software that we use to keep track of everybody's assets, print reports, and it also becomes the basis of the estate settlement. So we have all of the information about the assets. And then, of course, there are also asset review reports. And, of course, at the beginning of every year in the program, we ask our clients to send in the asset detail reports that tell us changes in the value of their assets, changes in what their assets are, tell us about new assets so that we can update all of our records. And then at the annual client meeting, we give out the asset review reports again so that you have an updated report of what our records show you have. It's often good to review those just to make sure everything is the way you think it's supposed to be, so we can make sure we're both on the same page. So again, we have to pay the just debts and expenses. Well, what are they? Of course, there's the funeral and burial expenses. I will say that oftentimes the funeral and burial expenses end up being paid by the surviving spouse or by family members before the administrative trust actually gets paid. But it's really important for those people to keep track of what they've spent on the funeral and burial expenses, because they can be reimbursed by the administrative trustees once the administrative trust is established. Of course, there's also the cost of last illness if they're not covered by insurance, medical insurance. And then, of course, we have administrative expenses. Trustees sometimes can be paid. Normally, family member trustees do not get paid. Although in some circumstances it becomes quite a job for an individual to be the trustee of an administrative trust. And so we often recommend that they keep track of their time, because it may turn out that they do, because they're taken away from other work that they would be doing or their livelihood, they should be paid some amount. Of course, counsel is an administrative expense, and as you know, we all have agreements which we offer estate settlement services based on that cap, and so we'll be talking about that next year, but that's counsel fees. And then, of course, there are generally accounting fees, and you'll see why in a couple of minutes. And if there's a need to appraise property, particularly real estate property or businesses, we need to get appraisals. And then, of course, we pay the lawful claims of the creditors, if there are any. So what are the taxes? Well, first of all, there are income taxes. The decedent, the person who died, who was the trust maker, their calendar year ends on the date of their death. Their final tax return for that year is their 1040, and so their tax year ends on the date of their death. On the next day, that's the first tax year of the administrative trust. That's the beginning of the first tax year. So the administrative trust's first tax year is going to begin on the date of death, and it can be either a calendar year ending on the December 31st, or it can be a fiscal year ending on the last day of the month before the month in which the death occurred. So if someone died in November, the last day of the fiscal year could be October 31st of the following year. And so now the trust starts filing income tax returns, and those are Form 1040. I'm sorry, 1041. So again, we have to do a final return for the decedent, and then we start paying income tax returns for the trust, because now the trust is regarded by IRS as a new taxpayer, and we have to keep track of our income and expenses, of course. Then, of course, there are estate taxes. There is the federal estate tax return if the decedent has a taxable estate. And by that we mean federally that their estate is over $5 million, and it's actually been increased somewhat because of inflation. I think it's $5,250,000 this year. If they have made gifts during their during the calendar year prior to their death, there also has to be a final federal gift tax return filed for them. That goes along with the federal estate tax return. If they've made gifts to children or grandchildren in a generation below the generation of their children, or below there's a number of years, it's 21 years. If you're younger than a decedent, more than 21 years, you're considered to be part of the next generation, even if you're just a cousin. So if there are gifts or transfers made to people who are in a generation below the next generation from the trust maker, we have to file generation skipping transfer taxes, and those are generally filed. That's part of the Form 706. Now, one interesting thing that's been added by the reforms of the taxes over the last few years is that the exemption amount, that $5 million, actually $5,250,000, is portable. meaning that if you die leaving a spouse and your estate is less than $5 million, but it's likely that your spouse will be more than $5 million thereafter, you might want to file a federal return so that the exemption amount that you did not use can be used by your surviving spouse. So, but you can't actually give the surviving spouse your unused exclusion amount unless you file that Form 706, even if you don't otherwise have to file the form. So there's often sometimes the question, well, do we expect that the surviving spouse will have a taxable estate even though the first spouse to die doesn't? And so if we do think so, we'll probably file a federal Form 706 anyway, just so that we can elect to give the deceased spousal unused exclusion amount, that's, by the way, a technical term, to the surviving spouse. And then, of course, there's the Massachusetts estate tax return. The Massachusetts exemption is $1 million, not $5 million. So any estate that is in excess of $1 million has to file an estate tax return and pay tax on the estate from $1. It's a little bit different from the federal exclusion amount under Massachusetts law. If you've got an estate over $1 million, you pay tax from the first dollar that you have. So there's estate tax returns that have to be filed, and part of our process is to figure out exactly when those are going to be filed and what we're going to be filing with them. So then there's accounting. Remember that the administrative trustees are receiving assets, cash, securities. They're receiving title to real estate. They're receiving insurance proceeds. The trust might be the beneficiary of retirement accounts. And so the trustees, when they retitle those assets and collect them, they end up with an initial asset amount. So then they have to account for that. During the administration, they're going to receive additional assets, perhaps. They'd be either income, or they might sell assets at a gain or a loss, so there'll be cash. And then, of course, they're going to make disbursements, like they might pay trustees' fees, costs and expenses, income taxes, estate taxes. And then they might make some distributions as well. Even though the trust hasn't terminated, they might make distributions. And then they might have some assets remaining. So if the administrative trust goes beyond a certain period of time, the trustees should, if there are a number of different beneficiaries, should prepare to file an accounting or prepare an accounting so that if the beneficiaries ask for information about how they're administering the trust, they can answer those questions. And the accounting requirement is a fiduciary duty to the beneficiaries, and so these are all things that have to be done. So essentially it's you start with, okay, what was my balance to begin with? That might be 0 at the beginning. What did I receive? Well, I received assets, I received income, I had gains and losses from the sale of assets, I made some disbursements for costs, expenses, taxes, etc. And then I made distributions, and when I'm done, the assets remaining is 0. So what are those distributions? Well, remember that after the administrative trust, there might be a marital trust, there might be a family trust, and there also might be, if it's the second spouse to die or if it's a single individual that's died, there are generally, in many cases, lifetime trusts for the beneficiaries that they wanted to benefit. So we have to establish those trusts, and we call those sub-trusts. And each one of those has to get a tax ID number. And once we've decided how we're going to allocate the assets between the sub-trusts, we have to retitle those assets in the name of the trustees of the sub-trusts. And they might be different people. And then the sub-trust trustees have to start making their initial investment decisions. So, ultimately the administrative trust is supposed to terminate. Generally it might take 1 to 2 years because it takes some time once you file the estate tax return to get a closing letter, whether Massachusetts or federal. And so it takes some time, but eventually you want to terminate it, and you file a final income tax return for the administrative trust, marked final at the top, and everything is transferred out to either the beneficiaries, whether they be individuals, or sub-trusts for their benefit. And then those trustees make the initial investment decisions. So here's how that looks. First we start off with the administrative trust. If we're making distributions and it's a marital and family trust, we might make distributions to the marital trust and to the family trust of some kind. We're going to allocate assets between them depending on how much assets there are. If there's less than $1 million under our current formulas, the family trust will be funded with all of the assets. If there's more than $1 million under current formulas, the marital trust will start being funded. Now, next year we're going to be talking to you about a modification to that formula, but I'm not going to get into that right now. But it'll bring things more, actually make things more simplified by doing that. And I'm looking forward to explaining it to you. So if there's an individual who died when we got the administrative trust, whether that's a surviving spouse or someone who wasn't married, then we're going to have sub-trusts for the heirs. There also might be outright distributions to people, particularly under Article 7. There might be outright distributions of cash or particular property. But generally, we end up with sub-trusts for the heirs, either after the second spouse dies or if there's no spouse when the trust maker dies. So what does the process look like? Well, there is typically 1 to 3 meetings. There's an initial settlement meeting, and at that, our main job is to figure out who's on the team that we're going to be relying on to do all of this activity that we're talking about. And then we start figuring out what the schedule of events is. How long is it going to take for us to retitle the assets, collecting insurance proceeds? If we have to sell assets, what's the schedule for doing that? Are we going to put a piece of property on the market? Identifying and paying the debts and expenses. If we're going to be filing estate tax returns, then we need to have property valuations. We have to prepare and file the estate tax returns. And then, of course, we have to figure out when the distributions are going to be made, at least on our schedule. And then we have to delegate the jobs. Who's going to do what? So there might also be interim meetings. Typically, there's an interim meeting before we actually file an estate tax return if one is due, because there are a lot of decisions that need to be made about potential disclaimers, for example. That's a legal no thank you. So if someone is the beneficiary of an IRA, they might decide to disclaim it so that they choose so that the option of the successor beneficiary is better for everyone. They might decide to do that. And so there are a lot of decisions that need to be made. We might decide, okay, so how are we going to fund the sub-trusts when it comes time to do that? Which assets are we going to put into which ones? How are we going to divide them up? And we need to make some investment decisions during the short term. Typically, in the administrative trust, the trustees are looking for cash because there's a lot of cash needs. So there's not a lot of long-term investing done. Excuse me. And many times it's important to liquidate investments, which of course is not necessarily a bad thing. Remember that when someone dies, there is a step up in basis, so that if you purchased a piece of property or you bought a security and it's now appreciated tenfold, when the decedent who owns it dies, the value of the basis in that property actually gets updated to the value on the date of their death. That's called the step up in basis. So if you sold that asset the day after death, there will be no gain because there's no difference between the date of death value, hopefully, and the value on the date of death. So figuring out what how those assets are going to be allocated and how they're going to be, how the investment decisions are going to be made with the cash, and then ultimately when we are finished with the cash, we might have some short-term investments other than cash. Then we're going to be allocating those between the sub-trusts. And of course, we need to make sure that we have sufficient liquidity to meet all of the cash needs during the period of administration. So there might also be some disputes. It's, in our experience so far, pretty rare for decedents to end up being involved with disputes, but there may be claims of trust makers' creditors that we dispute. There could be claims against the trustee. by contract or tort. That's liability for like an automobile accident. And so we've got to figure out our methods for resolving those. Those would be litigation. There might be ADR proceedings. That's alternative dispute resolution proceedings. And those are typical ways that things can get resolved. Also, there might be internal disputes. For example, I've been involved in some cases, not ones that I did, but there were revocable living trusts when someone died, and there was a major dispute in the family about who was supposed to get what. So there was a dispute about the trust, and that ended up in litigation, unfortunately. So there might be trustee-beneficiary disputes. There might be disputes between beneficiaries, and of course there are several different methods of resolving those. There is a time-honored and ancient tradition of having something called an interorum clause. And essentially what that says is if you contest the validity of the trust, you lose your inheritance. The courts really don't like those because it takes away the ability of people to actually litigate their controversies. So interorum clauses are difficult to enforce. What is easier to enforce, however, is if you dispute the trust, trustees may have the discretion to take the cost of that litigation out of your inheritance. That's called fee shifting. So there are also control provisions. For example, if the beneficiaries have the ability to hire and fire the trustees, they might do that and hire someone else. And then, of course, there is a majority rule decision, or generally a majority rule between trustees, because there can be disputes between trustees. Again, we have alternative dispute resolution, and if things really don't go well, we can end up with litigation. So we've gone through the process, we've filed our estate tax return, and now it's time to clean up and close up the administrative trust. So we have our estate tax closing letter, and that's essentially a letter from IRS and or the Commonwealth of Massachusetts saying that the return has been filed and they've determined that there is no tax due. Sometimes they actually determine that there's more tax due, or even that there's a refund. So you get a letter saying you owe more taxes, so you pay the extra taxes or you dispute it, whatever you might decide to do. And then ultimately, when that dispute is resolved, you get a closing letter that says there's no tax due. That's necessary to close up almost everything. Now all the debts and expenses hopefully are paid, and we have established, and it's time to fund the subtrusts by transferring assets to the trustees of those trusts. Of course, we have to confirm the successor trustee appointments. If we have new trustees, those trustees may or may not decide to accept the trusteeship, so we have to check with the trust instrument to see who those successor trustees might be, and confirm that they're actually willing to serve, and then have them accept the trusteeship. And then finally, one thing that many people really don't realize, and that is that once those subtrusts are created, there's an administration of those trusts that has to happen going forward. So the trustees of the trust should adopt, and we recommend that they do, they should adopt a trust administration policy. So what is a trust administration policy? Well, it has a number of different elements in it. First, the trustees should review the trust and make sure that they review things with the beneficiary to find out what the beneficiary's needs are, understand what the beneficiary's circumstances are, because the trustee's discretion has to do with administering the trust for the benefit of the beneficiary. I've seen some circumstances where corporate trustees had no interest in asking the beneficiary what their needs were, but those are rare and not revocable living trusts typically. But the individual trustees and even the corporate trustees or CPAs, if there's co-trustees, they should determine what the beneficiary's needs are and become familiar with the circumstances of the beneficiary. Then to review the trust terms and decide what and make a statement of what the trust purpose is. That's going to be based on the terms of the trust and what the trust maker wanted to happen. So it's important for the trustees to know that they're familiar with the terms of the trust and they understand what the trust maker's purpose was in establishing a trust. And once they've determined those with the needs of the beneficiary, they can now start figuring out what their long and short-term investment policy might be. How are they going to invest the trust? Are they going to invest in long-term investments that might not be currently liquid? Or is there a period of time in the not-so-distant future when we're going to need some liquidity because the beneficiary needs to go to college or whatever that might be? And that has to do with what our distribution policy is going to be. Are we going to make regular monthly or quarterly distributions to the beneficiary? And if so, where does the money for that come from? Do we invest so that we have plenty of income coming through, or do we invest so we have growth and then realize capital gain? So we can make distributions to the beneficiary. And then, of course, that all involves accounting and tax policy because, as we remember, trusts are taxable entities, and they have to file a Form 1041. And the one thing that's kind of important about that is that trusts tend to get to the highest bracket particularly in the federal income tax system very quickly. So if you're, I believe this year, if you have $12,850 of income or thereabouts in a trust, you're now at the highest income tax bracket under the code. So what do you need to do to avoid paying that tax? Well, the tax law says that when you make distributions to the beneficiary, you are distributing out that taxable income, so you get a deduction for distributions of income to the beneficiary. And there's tiers. So you distribute out ordinary income first, and you distribute out capital gains second, and tax-free income is actually second, I'm sorry, and then capital gains third, and finally you distribute out principal. So if you're making distributions to the beneficiary and your income is equal to or less than what your distributions are, the beneficiary will pay the income tax on the trust's income because the beneficiary receives it. And that, of course, is going to have an issue of, well, okay, who's going to pay tax at the lowest rate? If the beneficiary is a very high income taxpayer, they might actually pay more taxes than the trust would, and they prefer not to receive distributions and let the trust accumulate until they really need it or decide to retire. On the other hand, if it's a low income taxpayer who's the beneficiary, distributing out the taxable income is a much better tax strategy so that the trust doesn't have to pay tax at a high bracket. Then, of course, there's delegation and allocation of responsibilities. Everybody has a day job, particularly individual trustees are not always that trained, for example, in investments or accounting. Some are, some aren't. So the trustees might decide that one or the other of them is going to take primary responsibility for one or more functions of the trust. Or they might decide, okay, let's hire somebody to do that particular job, for example, accounting, and that's going to be an expense, but we know that because we need to have it done correctly. And we can also delegate the investment authority as long as we establish an investment policy. And we've already figured out what our long-term investment policy is going to be. We might work with an investment advisor to do that. So the law allows us to actually delegate the day-to-day investment decisions to an investment advisor who we've chosen prudently. And that investment advisor then follows the investment policy that we've agreed to. And then, of course, we have to review what the investment policy statement has done, review the performance of the investment advisor. If a co-trustee is actually making the investments, we want to make a periodic review of how well the portfolio is performing. We might want to review periodically what the distribution policy is or the tax policy, and make changes in how we allocate responsibilities and delegate them. So it's important for us to understand that right at the beginning, one of those subtrusts needs to take some action to figure out exactly how the trust is going to be administered, and that's what we call a trust administration policy. So we find that one of the important things that we do once the administrative trust is ready to terminate is to work with the trustees of the subtrusts in advising them and helping them get together all of those policy decisions so that they can move forward on a sensible basis. So that is the end of the process, establishing the administration policy for the subtrusts and getting them established. And at that, we close out the administrative trust. And then, so that means then is congratulations, now you know what to do. So we have about 15 minutes left, and I'd like to open up for questions. Please feel free to unmute yourself if you'd like to ask any questions, and ask away. You know, one of the more difficult things about doing online education is that it's very difficult to get feedback from the audience because you can't see them. So you don't know whether people have quizzical expressions on their faces, and you can't see them raising their hands unless they hit the chat box on the right-hand side. So I see that a couple of people have unmuted themselves, so it looks like we might have some questions. Lee, how about you? Do you have a question?
No questions. I just wanted to unmute just in case I missed the other people's questions.
Oh, okay. Anybody else have any questions? Steve?
Frank, there was one part of your presentation where you talked about taxes that might have to be paid.
Mm-hmm.
Are most of those taxes that we've set up to avoid having to pay?
Yes. If we have the basic tax strategy for married couples, for example, is to use the marital deduction. So we fill up the family trust with assets that are actually going to be taxed. We're using the coupon. You know, that sometimes we refer to the family trust as the coupon trust. So everybody has a federal and state exemption amount. We call that the coupon. So we fill up the family trust with the coupon amount and say to IRS or to the Commonwealth of Massachusetts, please tax me on these assets because I know that the tax is going to be zero. And then the rest of the assets go into the marital trust, which of course is qualified for the marital deduction. And so there's no tax on assets that get transferred to the benefit of the surviving spouse. So even if you have an estate of $20 million on the death of the first spouse, there should be no estate tax unless you decide you want to pay tax. So typically that's the way it is. It's on the second spouse's death. If the overall assets of both spouses is greater than, for example, $10 million under the federal system, I guess it's $10,500,000 now. If their total assets is going to be over that, then there will be tax on the death of the second spouse. But remember that the family trust is going to take, let's say it takes the first $5 million. The family trust is going to grow. Remember the 1, 2, 3 of estate planning. So the last one that you're going to use is the family trust if you want to pay expenses. And that's going to grow, and you never have to pay tax on that again because you already paid it. All right? So the surviving spouse may have assets, and if the surviving spouse has assets under $5 million, again, we end up with no tax on the death of the surviving spouse. So that's how the marital deduction works. Of course, if a couple has more than $10,500,000 or whatever the escalation goes to, ultimately there will be some taxes that are paid. Did I answer your question, Steve?
Yep. Thank you.
Okay. Any other questions? Well, I guess there are no further questions. If you have some or you think of some, please feel free to call me afterwards. You know the number. It's 617-630-5700. I'm extension 1. And if there are no further questions, I guess we'll call it a day. And thank you all very much for attending.
Thank you, Frank.
Thanks, Frank.
Thank you.
You muted or something.